Welcome over another episode of Financial 15. Lots of great information today. We're covering a very common question we receive. It has to do with gifting money. Specifically, if you gift money before you die, how can that strategy help you save tax? We'll have the answer for you. You definitely want to stick around.
Do I want to do it in my state? Should I do it when I'm alive? Should I put it into a trust? How do I solve these questions? Again, what we want to do is we want to tell you gifting while you're alive, what can go on and how that works for you. So if you want to find out more about this video or any of the other ones we've done, please go to our YouTube channel and subscribe. Great content there. Lots of different topics that you can find out information on as well. Like us on Facebook. And most importantly, visit our website at beckerorr.com. Blogs, events, videos, global scenarios, everything that we've done beforehand. But today we are dealing with gifting money before you die. Why do we want to do it? Does it give us tax advantages? How is this going to play out? And when should we do it? Clint, what's the first thing we should look at?
Well, generally, you want to do it before you die. That's kind of the topic of the video for the
Exactly.
when. In addition, it's usually in retirement, usually later retirement. If you're 42, you're normally not giving your money to your kids and your grandkids as part of an early inheritance. You're usually worried about your own retirement. But later in retirement. So often folks retire, maybe the first couple of years are still sorting out their budget, their needs. It takes a while to really settle into the routine of retirement. Ideally, you have that part figured out. So that way you can do a good estimate of your needs. You have a pretty good idea of your budget, what year to year looks like. You can make sure you have ample assets set aside for your own retirement needs. And then the additional is where this strategy would kick in of you gifting the assets before you pass away. And it's important to mention this, Kevin, that this is going to be part of a larger estate plan, right?
Yeah, I mean, that's basically what it is. I mean, you're looking at the overall scenario. If you have that financial estate plan that's been done, you want to know what's the best option. Do I trust it? Do I put it in when I die? Things will go from there. But yeah, a lot of the times giving that money away before you die has huge impact going forward. If you're the person giving away, you get to see the instant joy and gratification that whoever's getting it is going to find out, and they get to spend that money while you're alive, so you get to see it. Two is that it can save you tons of taxes depending on where it's taken from as you go forward. So, I mean, again, this is money that you've already considered you don't need. So might as well let's get rid of it now. That way I don't have to worry about it. And I'm also not paying taxes on it going forward. So I can have benefits that could come along those lines as well. So those are some of the bigger reasons. But there's other stuff that goes on with the estate plan, isn't there?
Yeah, so that's very high level, the estate plan and how this would fit in with the overall estate plan. We have to mention, we're really talking about non-registered accounts here.
That's right.
For investment accounts. So if you have money in a RIF or in a TFSA, you really wouldn't apply this strategy. It's only if you have additional funds that are in those non-registered accounts. And you say that for two reasons. If you pass away and you got a bunch of money in a non-registered account, likely that'll go through your estate. Depending on where you live, there could be probate fees, there could be additional taxes, and then it goes to your beneficiaries. You can bypass all that just by gifting them the money right away. And then number two, those non-registered accounts, kind of like a pay-as-you-go system. Every year you probably have to pay a bit of tax based on the investments in that account. Well, if you gift the money away, you no longer have to pay that tax every year, so you could save a bit of tax as well. But important to note, it does usually apply to these non-registered accounts. I'll let you go through a quick review here, Kevin, of some of the nuanced detail here of those various accounts.
Yeah, and that's exactly it. I mean, there's basically the three types of accounts you get. You get your taxable registered accounts, your RSPs, your RIFs, LIRs, LIFs, PRIFs, whatever the case may be. And again, any money that comes out of there, fully taxable, all income. And of course, that often has withholding taxes applying as well. So if you're going to get a large chunk of money and try to give it out of here, you're paying a large amount of tax to get that done. And that's probably not something that you want to do, including in your year there, because you're not getting the same benefit. Tax-free savings account, different. I mean, usually this is money you've put away so that you can utilize it down the road, because anytime you take money out of it, there is no tax consequences to you. So taking it out really isn't saving you those taxes going forward at all. The third one is the non-registered account, which again, you are paying tax on most of the stuff that's in there, either interest income, dividends, capital gains, return of capital, whatever the case may be. By giving that money away, you are basically eliminating that tax consequence, which leads to sort of a third point. The other two that we've mentioned, taxable registered and TFSA, they have beneficiaries. So if something happens, money can directly go to your heirs. On the non-registered side, there is no beneficiary. That is a huge factor to basically consider going forward, is the fact that this money may, as Clint stated before, go through your estate and doesn't bypass because there is no sort of beneficiary scenario there. So again, being able to deal with non-registered assets, can save you taxes, can give money to people right now, and also doesn't have to worry about that beneficiary scenario down the road.
Yeah, and if you use a quick example when it comes to the beneficiary, if you had that TFSA, could you take money out and give it to your kids? Sure, you could. Why not? There's not going to be a tax scenario there because it's a tax-free account. However, a TFSA, you are able to name a beneficiary. Maybe you name your spouse, maybe you name your kids or grandkids. You can name whoever you like, and then the money bypasses your estate, so no probate fees, no legal costs, and it goes directly to the beneficiary, completely tax-free. So that's why we don't really list the TFSA as part of the strategy. Usually you're focusing on the non-registered accounts because you can't name a beneficiary. If you pass away, that money likely going to go through the estate, and then you're going to have those probate legal costs. And while you're alive, there could be a year-to-year tax on those non-registered assets. So that is a big difference. The account you focus on, the beneficiary. Another key point here, Kevin, there's a couple of them. I'll talk about this one, is that if you do gift the funds from that non-registered account, like you talked about, there's interest, dividends, different sources of taxes year to year on those non-registered investments. Well, if you gift that away, that income could come down, which could be to your benefit. Because now if you have income-tested benefits, an example is listed there, the OAS clawback. If your income's down because you've gifted away some of the assets, it could pull you below those thresholds, help out with the income-tested benefits. So kind of an additional perk there. You don't pay the tax. Plus, it could be one way to lower your income, which could help out with these additional government benefits. And then a big one here, Kevin, really which makes this whole strategy possible, no gift tax.
Yes, Canada, unlike the US, we have no gift tax. So as long as you are giving money to an adult child, basically what happens is you can give them the cash. You can give them an investment, whatever the case may be going forward, you can get them that money and there's no gift tax that you have to pay on it. It's basically saying you're writing a check, here you go, take it, enjoy, and we're done from there. So that's a big factor to go, because if it was taxable beforehand, now the tax has been eliminated out of your hands, depending on what the person is that gets it, does with it. There would be tax now in their hands, not yours. And that's a perfect way to deal with it because Canada has no gift tax.
And that's really what makes the strategy possible, right? If you had a tax when you gave the money, it'd kind of defeat the whole purpose, but not the case in Canada. You can give money to adult kids. You can give them cash. There's not a limit. If you want to give them $1,000, $10,000, maybe you're feeling really generous, you give them $100,000. No gift tax is going to apply regardless of the dollar figure there. However, and there's always a however when you're dealing with the government, there could be attribution rules that might kick in. Now, the attribution rules are a little different. If you give them property, you give them assets, or you give them cash they then use to buy an asset, depending who you give it to will determine whether or not there's an attribution rule. The attribution rule just means if there's a taxable event there, like down the road that asset earns income or a capital gain, it comes back to you and you have to pay the tax. So they don't let you get away from the tax. It gets attributed back to you. Two highlights here. There's lots of detail. We're going to hit the highlights. If you give something to your spouse, if I give my spouse a stock or I give them money, they buy a rental property, that income, the capital gain could flow back to me in that scenario. Or if you have minor kids or grandkids in that case, the capital gain would stay under their name, but the income could come back to you. And the key here, you mentioned it earlier, Kevin, no gift tax in any of these cases, but there could be attribution rules depending on what you gift for minor kids and for your spouse. Adult kids, no attribution rules. So if your child's over the age of, kids I should say, over the age of 18, you give them a lump of cash, no gift tax, and then whatever they do with the funds is now on them. It's not going to be coming back to you. You don't have to worry about that tax bill. So those attribution rules don't apply to adult children. And that's really what we're focusing on here for the strategy. Non-registered assets, adult children, that's really the ideal setup for this gifting strategy.
Yeah, and I mean, that's normally the way that these things start to work out, is that it is the adult children. And usually you're at that phase, as you mentioned, right off the top. We're not doing it at 40. We're doing it maybe at 75 or 80, at which point should our children be there? 9 times out of 10, they're going to be adults. And that's the way that you want to deal with it going forward. But again, the attribution rules, that's the reason they're there, is because the government does not want you to avoid tax, maintaining this whole thing on your own. By giving it to an adult children, you basically eliminated that scenario. So yeah, having that, making sure you give it, it's a perfect strategy to deal with. And of course, this leads back to the all-encompassing Becker Orr mantra. The way this works, have a plan. So if you've done a financial plan, an estate plan, if you do a plan, these strategies will help make things easier for you going forward. We'll be able to sort of let you know that, okay, hey, look, based on what your income is, you may have all this left. take a look at this as a strategy. It may be something worthwhile. So having a plan, again, very important. Doing it at the last minute is never really a quick scenario to deal with, but the plan is what's going to make this really worthwhile going forward.
Yeah, and you have to keep in mind, again, this has to reflect your goals, your objectives, which are a big driver of those financial plans, right? If your goal is to spend all the funds and really enjoy retirement, well, then this strategy is not for you, right? If the idea is you want the next generation to have some level of an inheritance, well, this might be one way to achieve that while you're still alive and save tax. That's the idea, but all of that is encompassed in your overall financial plan, so important to have that in place. If people have more questions, Kevin, where can they go?
They should go to chatwithclintonandkevin.com. We are more than happy to answer questions on this topic, anything dealing with that quote unquote plan that we want you always to get, as well as anything else along the financial 15s or anything else we put online or on our YouTube channel. Please check it out and please let us know. We're here to help and we'd love to be able to do that for you. Other than that, I think that we've covered sort of that gifting money before you die scenario as one strategy to deal with. We have more down the line. Any sort of parting words you have for the people that are watching today?
I think we covered it all, so we'll end it there. We'll be back again soon with another video. Take care.